short of it is.
How about at the end of the day, do you do anything like I'm really fast? Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Okay, we are live, and thank you to everyone who's on the line today. I beg your pardon, I was a little bit late today. I'm recording from the office today, which is not normal. It's not normal behavior for me to be in the office on a Wednesday, but tonight we are going to Wangaratta in regional Victoria. So shout out to anyone who is regionally located in Wangaratta, which is, I think it's northeast Victoria. I'm heading up there shortly with Kate and Pete Wargent from our team. And I've got to admit, I'm excited to come up and meet everyone in Wang and surrounding areas and the Highlands and beyond, and to all of the, if you're in Bright, if you're up in like the Alpine region, love to see you. Come down from Myrtleford, say good day tonight. We're at the Gateway in Wangaratta. So today we've got none other than Scott Phillips joining us from the Motley Chief Investment Officer, and it's an absolute treat. I can see a few of you in the chat already have mentioned his name, and you know what he brings, and it's really exciting for me in particular, having worked with Scott in the past and just admired him from a distance since. It's always a pleasure to be able to chat to him and pick his brain, because his thoughts on not just companies but also the financial system and the way we operate as a society is always so refreshing. But before we get to that and we welcome him, we have to do what is obviously very important for the show, and we have to bring in a quick reminder to say anyone that's subscribed, please subscribe. No matter where you're watching this, if you're on YouTube, on Rask YouTube, on Selfwealth YouTube, on the Australian Shareholders Association, or maybe you're on Twitter, LinkedIn, or Facebook, don't forget to hit like or subscribe or whatever it is on the platform that you're watching on. If you do hear me or Scott respond to any comments and questions today, which we do encourage you to bring, just remember that firstly, it's general financial information only. But secondly, you may be hearing a comment that was from a different channel that you're not on. And that's just because we stream simultaneously to many different destinations. And so that's why it may be a bit confusing, but we'll read the questions out nonetheless. And as Rob Marfell from Selfwealth is saying, over on the Selfwealth side of things, I can see that he's saying, click that subscribe button, everyone. Why not? Give it a go. Okay, this week's joke. Just got hospitalized due to a peekaboo accident. They put me in the ICU. For any dads out there, this is a wonderful dad joke. Feel free to use it. Maybe if your child's under the age of 10, it's acceptable. After that, they'll probably just look at you and roll their eyes. But feel free to come back every week for terrible dad jokes, and I'm sure to delight you there. So as I said, this week we have Scott Phillips on the show, which I'm absolutely delighted with. In coming weeks, we have a very wonderful lineup to share with you. Some great names and faces on this list here, including some retirement stocks. We've got a macro update coming. We've also got a segment called Core Satellite Avoid. This is where we will be calling for your suggestions, and we'll pass them through a filter of where they might sit in an investor's portfolio. So you can send us in any of your requests. You can use the chat right now and just send a comment in, or if you're watching this back on replay, to say, hey, I'd love you to cover X, Y, Z. And if it's maybe an ETF, maybe it's a managed fund, maybe it's a listed investment company, maybe it's a property, maybe it's whatever, chuck it in the chat and we'll see what we can do. We can probably only get to about 5 in one session. That's Mel there on the screen, so she'll be joining me for those. If you're not already coming to the Sydney Roadshow next week, check it out. Tuesday night, 5:30 p.m, the Rask Roadshow. I dare say once all is said and done, we will have sold over 1,000 tickets, which is absolutely delightful right across Australia. Here's a shot from Adelaide. And it's a wonderful thing you can bring your partner or your friend to. In fact, that's what we would encourage you to do. It is a lot about investing, but it's also about life and just connecting with people who are like-minded. Tickets are only $40. You can find out more by just Googling Rask Roadshow. So for today, We've got Scott Phillips, and like I said, I really admire Scott and the way he goes about all of his investing. So Scott is the Chief Investment Officer of the Motley Fool Australia. Many of you will know him not just from the Motley Fool, but maybe you're on Twitter and you follow him. Maybe you see him on the television every week. Maybe you hear him on the radio. It's an absolute delight to have him on the show today. And we'll be asking him a few hard questions and some easy ones, but he'll also be sharing with us some ideas that he may or may not, maybe he can confirm when he comes on in just a moment, that he may have shared with the Share Advisor community over at the Motley Fool Australia. So the Share Advisor service is, I think, and I'm pretty sure it is, the longest running investment research service offered by the Motley Fool Australia. And in my words and in my opinion, very well performing over that long period of time as well. And Scott heads that up for the team over there at the Motley Fool and indeed the community writ large. So without further ado, I might welcome Scott to the chat. Scott, welcome to Rask Live, mate.
Thank you, mate. Lovely to be with you. Hey, can I start with three things? Firstly, thank you for the very kind words, mate. Very much appreciate it. We used to work together. I'm glad to see how well you have done with the whole Rask network. You're doing a spectacular job there, mate. So that's the first thing. Huge raps for that. Second thing, I want to say, really cool. You've taken Rask right around the country, and I will say, I'll give you a bit of a compliment back. Some of our team actually attended your Gold Coast event, so they had a great time. Really impressed. So if anyone's considering going, particularly if you're in Wangaratta today, but if you're just anywhere unsolicited, I'm not getting paid for this. Owen didn't ask me to say this. You didn't know I was going to say this, but get along there. Mate, my third thing to start off, can I throw a dad joke at you?
Yeah, absolutely you can. I need some help if you couldn't tell.
Mate, why can't ants catch COVID?
That's a good one. I have no idea.
Because they're little antibodies.
This is
You're welcome.
It would seem like you have form here, so that's so that is great. And if you want to give Scott a score out of 10, Rob gave me a 9 for mine, which I dare say Scott's is probably a 19 based on that. So, mate, thank you for that. I do have a couple of icebreakers that I would like to give to you, actually.
Yep.
And one of these ones, the first one, which I've got written down on my phone just here, is how often do you check your brokerage account? So how often do you actually log in and check it?
Mate, that's a great question. So I use Perla and CommSec personally. I got that Perla report we did last year. Less than once a month, I log on to that particular account. I do log on to my CommSec account more frequently, actually usually for the information market levels. I do, as you said, radio and TV. So kind of people ask me the all odds numbers and that kind of stuff. So I do that. My own portfolio, I'm trying to think the last time I actually checked it, mate. And it was last week. And I'm not even sure it was last week, but I haven't checked it this week yet. I mean, I kind of know roughly where prices go. Here's the other thing. If you ask me the cost base of any single one of my companies, I could not tell you. I have absolutely zero idea. I can look it up. I just honestly couldn't tell you what price I pay for some of those things. I'm a long-term investor, mate. It's the only thing you can do by checking your brokerage account is distract yourself and focus on the noise rather than the signal. So I try not to do it. I'm not perfect, but yeah, no, I normally more than a week between checking the portfolio.
That's really good. And for a lot of folks, that's avoiding, tempting fate, I guess, is a really important thing. I did actually, I'm going to ask you one here just off the cuff. I did actually beforehand, and we're going to get to these 5 companies in just a moment, but I did ask you for the position that you know of that you've held the longest. So can you tell us what that is?
Yeah, so I had to look up the detail again. I don't know these things off the top of my head. By the way, I was asked on Twitter, I mentioned on Twitter, during the political campaigns, Albo apparently couldn't remember the 5 points of some policy plan.
Yeah.
And I kind of, not to be political, but I came to his defense to one degree. I said, look, I couldn't tell you the top 5 positions I own in order, and certainly not in absolute weightings. And someone said, well, you're supposed to know these things. You do this for a quid. Again, it's like, memorizing your positions is not very useful. More useful is obviously doing the work in terms of getting through it. So I had to look it up. Turns out it was Telstra. Back in 2006, I bought those shares. So demutualization kind of there or thereabouts, or just asked me about it too. I can't remember why. But I literally had to go back all through my record of trades to find out. There were companies I did buy before that I subsequently sold. But yeah, 2006 was the earliest position I can find for a current shareholding that I still own.
Wow. Okay, that's great. So if this should be, I know David Gardner, who's the co-founder of the Motley Fool, is a huge advocate of things like this, and talks about he always plays these games on the Rule Breaker Investing podcast, which I listen to every week, and he talks about things like Fang Score and these types of things. I would love it if anyone right now, even just pop it in the chat. And you did get some good scores. Graham did say that our jokes are terrible, which is fair enough. They are pretty bad, but I think that's kind of the point. Dads get something from them, but the kids definitely don't. So David would say something like, go into your brokerage account or check it, or just put it down in the chat right now. What's the longest you've held a share for? Tell us in the chat. That'd be fantastic. So my second one for you is, if I could give you just 3 sentences, this is kind of like a false choice maybe.
Yeah, go on.
If I give you 3 sentences to describe Bitcoin and whether it should be in someone's portfolio.
3 sentences. Okay. Sentence number 1. Assets that don't produce anything of value are incredibly hard to therefore value. So I'll say, if you don't produce any outcome, any content, income, any productive value, very, very hard to value. Second thing I would say is that when you rely on others to therefore provide or substantiate the value of an asset, you are going to do it really, really tough, because you're relying on the sentiment, mood, perspective of others in an absolute sense. Yes, share prices are relatively that, but based on a real asset. The third sentence, I suppose, I know I've kind of editorialized the first 2. The third one I'd throw at you is, I don't think Bitcoin is an investment grade asset. It is potentially intelligent, potentially not intelligent speculation, but I don't believe it's something that has been around long enough. I don't own gold either, and I don't think gold is an investment grade asset either, which I know will annoy a lot of people, which is fine. But at least it's been around and has a basis for valuation. So if you wanted to own gold, there is some sense of being able to substantiate a super long-term value for that. If you want to own Bitcoin, knock yourself out. I don't think you can describe it as using my definition, as an investment. It must be a speculation, because there's no way to substantiate the value. There's no productive output from the asset on that basis. I used to own $100 worth of Bitcoin. I sold them a few months ago just because I just had them for like years and just got rid of them. But I wouldn't own Bitcoin as an investment. I bought $100 just to follow along, not as an investment proper. So no, I don't think it belongs in an investment portfolio.
Fair enough, mate. I've done the experiment as well myself, and it's ended poorly for me. But that's okay. It was an experiment, and I'm glad I did it. And I know the reason that I asked this question is not to put you on the spot, but it's actually to reinforce a point that if people don't listen to Scott's podcast, follow Scott on Twitter, and they can see the back and forth between Andrew Page and Scott Phillips. It is one of the most entertaining things you'll see in Australian finance. So you can go and check that out. I highly recommend going and checking out. Follow Scott on Twitter, of course. So there was actually a question which I think was really interesting, which was from Colin. Just a quick one I might put to you, Scott, which was just around DRPs. Because you've invested for so long, do you use dividend reinvestment plans?
I don't. I think they're fantastic for people who don't want to be super engaged in their investing and who hold a high conviction portfolio. So if you're someone's like, I don't want to deal with the cash, I just want to be reinvested. In 40 years' time, I'll be happy I did. I think it's a really, really super useful tool if you know yourself and you know they're right for you. I've got probably 15 odd ASX shares in my portfolio. At any one point in time, I don't necessarily want to be buying my 13th, 14th, or 15th best idea, which is what you do with the DRP. You take the money and reinvest it in that idea. So generally speaking, I'd rather take the money and then redeploy that to my best idea. I will say, really, really important, I have a separate bank account for my investing cash. My money goes in there when I get paid, my investing portion anyway. Dividends go back into that account. So I'm not tempted to spend it. So if you're going to spend your dividends, use a DRP. If again, as you said, you can't give personal advice, but general advice. If you're going to spend it, use a DRP. If you don't want to think about it, you just want to let it compound away. There's some great stories of bank shareholders from the 80s and 90s who did that. By all means, just let it compound away by itself. But it's also true that I think that, I said, if you own 15, 20 companies, you don't want to be necessarily reinvesting the dividends in your 20th best idea. So personally, I take cash, reinvest it that way. But I'd rather people use a DRP than let that money drift away into general spending or maybe never getting around to adding it somewhere else.
That's fair enough. I like that, mate. And I did see a bank comment come through here from JJ. Said, owned ANZ shares since 1985, which is
Oh,
incredible.
nice. Well done.
Helen
JJ.
has owned Telstra since 2006.
Nice.
Marco's held something that was nameless for 15 years, which is fantastic stuff. Okay, so I've got a couple more questions one more question before we get to the 5 stocks.
Nice.
And this is one that's been very topical lately. And I've got to say, it's one that is still forming in my mind. So I'm curious, as someone who thinks about these things a lot, what it means to you. And it's for everyone here, I would love to know your perspective on this, which is, how do you weigh up whether AI, artificial intelligence, I know this is a buzzword, I've come up with the 2 big ones, which is AI and Bitcoin.
Yeah.
How do you think about their role in replacing a lot of the investing world? So whether we're investing in ETFs, whether we're investing in shares, you name it, like how does that impact what we're going to be doing?
Mate, so one of the great things about working the Motley Fool, as you know, is I get to say I don't know when I don't know. I don't have to make up an answer. So the first thing I'll say is I really don't know 3 years out. AI has just, we almost take for granted now and forget that it was 18 months ago. It didn't exist in any meaningful way. ChatGPT, these sort of the drawing apps, the video apps, all that kind of stuff, they didn't exist, literally 18 months ago, right? So we're still coming to grips with it ourselves, and I don't know. Right now, I did a chat GPT test and said, show me Australian ASX listed companies with competitive advantages. And it brought back every single company on the ASX. And the reason was it found everywhere company XYZ said, oh, this company has a competitive advantage because X, because Y. And so what it was doing was it's at the moment at least, it's a relatively simply a natural language search engine. So if everyone describes companies having a competitive advantage, it will tell me, well, these companies have a competitive advantage. You're welcome, Scott. And there's no kind of, we're an investing podcast. Let's talk about Ben Graham. In the short run, the market is a voting machine. In the long term, it's a weighing machine. Now, right now, AI just tallies the votes. And that's fine. But all it really is telling you right now is, here's what everyone else is saying. So I think if and when AI is able to generally, and I don't think it's that far away, mate, really honestly, what it will be able to do is to use the data, the phenomenal amounts of data known to man. Now, the limitation is most of that data is only post-internet. So we're only really talking about 28 years worth of it, right? But over time, it gets more and more data, and it is therefore able to look at cause and effect. So what circumstances existed for those companies that then went on to do great things. Now, speaking of great things, I've got the book behind me, Good to Great by Jim Collins. Yep. If a computer, probably when, can work that stuff out, then that gap will close, the ability of doing that. What it can never do is look forward, I don't think, with a lot of confidence, know what the future might bring. So if you're trying to value an asset, an income stream from an asset, that's been able to be done with computers for decades. If you could take a slower growth business like a Woolies or a Endeavour or a Wesfarmers or something else and say, this kind of trundles along at this rate, I can reasonably a computer price for that. And there's already those sort of things out there. I'm not entirely sure we'll be relying on AI to predict the future. But the only thing I would say is if when it happens, it'll simply it'll arbitrage away some of those gaps. Stock pickers will either have to be much better or we'll go and find something else to do. And that might include me. And that's fine if that's the case. If I've said to our members all the time, mate, if I'm not beating the market, go and buy an ETF and go fishing. Don't pay me to do something you can do yourself. If I'm adding value, then great. If I'm not, then go and do something else. So I wouldn't bet against AI, mate. If 5 or 10 years' time, if there's fewer of people like me around, then I won't be the slightest bit surprised, and I won't stand in its way. If our members can get a better result from that, it'd be, frankly, just immoral and unethical for me to charge them money to do something the computer can do. Thus far, so far so good. But I wouldn't rule it out.
Yeah, fair enough. I like that. I'll come back to like some of the questions that we've faced over the years, which is that a lot of what we have been able to automate is being automated. So like you said, like the mathematical models, like we've had Excel for a long time for a lot of people that are familiar with discounted cash flow analysis. Not that might make you a better investor, to be honest, but we've also, Buffett tells these stories all the time of he doesn't use a computer to do these types of things, and yet he's still maintained an edge in investing, right? And so there, as you said, in certain respects, it's just kind of knowing where your competitive advantage is as an investor.
Mm-hmm.
Now, there was a great question that came through before, which was from Dave, but I'm actually going to switch screens, Dave, and I'm going to show you something that Scott has kindly sent in advance to me, so I can pop it on the screen here. And I'm happy to take any of these companies in whatever order and however you want to go about it, Scott. But for folks that are watching, maybe if I'll just pick one or two questions out as we go through. But maybe if you just identify one. The question from Dave was, do you use ETFs in your portfolio at all? So maybe that's a natural starting point, maybe with beta shares.
Yep.
Can you just talk us through this? And I can pull some things up on the screen as we go through.
Nice, mate. So can I answer Dave's question as I introduce the NASDAQ ETF?
Sure, yeah.
Beauty. So yes, I absolutely do. I own two in my personal portfolio. I think I own 2 or 3 in my superannuation fund, and I've got a couple for my young bloke in a separate account. ETFs are great. ETFs are really, really good. You know, I'm supposed to be a stock picker. I'm supposed to, you know, if you read the papers, the talking heads or the asset managers and the fund managers tell you how terrible ETFs are and how their passive investing is destroying the market. It is all complete bunk, in my opinion. They're just talking their book, right? Because they're either they're lying to you or they're lying to themselves, and probably both, as I like to say. So. You know, let's be really, really clear. Passive investing is spectacularly good. If you can get the average market result, less a tiny amount of fees, and it firstly keeps you in the market. Secondly, avoids you making errors of stock picking. Thirdly, you know, you automate your investing because you're that style of investor. It's just a great, great, great thing to do. So I love ETFs. We have a service in the Motley called ETF Investor, by the way, which is not a plug, but just to demonstrate specifically, far from running away from this stuff, we're like, you know what, this is great for a lot of people and you should do it. If you then want to try and beat the market, then by all means, do it carefully and thoughtfully, then try and pick some stocks. So that's where I start. Let's go to the NASDAQ ETF for that reason, although it's a little bit different. So for me, there's 2 reasons I own ETFs in my portfolio. For my young bloke, and by the way, I gave my nephews and niece, I kind of helped my sister set up a portfolio for them. That also has this NASDAQ ETF in it. So again, another use case. What does an NASDAQ ETF do? It gives Australian investors a few things. Firstly, it gives you the opportunity to invest overseas without having a overseas-based brokerage account or needing to buy shares on a different exchange. So if you just want to look at that, then do that. Secondly, and related, the opportunity for diversification is enormous. 98% of the world's stock market is outside Australia. We'd be mad to think we can only invest in or should only invest in Australian companies. I've used the example before, Owen, maybe even with you, that investing only in Australia is the equivalent of going to the real estate agent saying, look, mate, I'm looking for a house, but please only show me houses in streets that start with the letter B. You know, you wouldn't do it. Why would you do that? It'd be crazy. And so if you said to someone, why would you only invest in Australia? People will rationalize it. Well, I live here, I work here, I know the companies, it's the right time zone, right currency, and they're genuine advantages of ASX investing. But I think you want to invest more broadly than that, including in the US and around the world. So there's that. So let's go to the ETF itself then. The ETF itself it mirrors the NASDAQ 100. So the code is NDQ. It's the beta shares NASDAQ 100 ETF. It takes the top 100 non-financial companies on that NASDAQ exchange. Now, they are almost certainly going to be very, very predominantly technology-based companies. Now, I own some of these personally, by the way, my own portfolio with a US brokerage account. So there is some duplication there, which is completely fine. But think about the businesses that are atop this list. Think about the Apples, Amazon, Netflix, Google, or called Alphabet these days, Facebook, Nvidia. The list goes on, right? That's just that's top of my head. These are the companies that I think are, frankly, they're growing phenomenally and continue to, and I think they're going to keep growing for years. And we spoke about AI. Think about the technological advances in the future. Some will absolutely come from outside the NASDAQ, but most will eventually list there and then probably grow on that NASDAQ. So I've said before, it feels like a horrible marketing line, so I don't love it, but I use it because it's actually true. These companies are inventing the future in my mind, quite literally. You know, they're going to be the ones that are, you know, it doesn't mean stuff will happen outside the NASDAQ, but realistically, that's where the growth is going to come from, I think, or a large chunk of the growth anyway. So I would be remarkably surprised if the NASDAQ index as an index, it'd be super volatile because tech stocks are, but I think it'll outperform the ASX over an extended period of time. So I want the diversification of currency, geography, and industry. I want those companies, exposure to those companies in my portfolio specifically. And I think, back to the ETF theme, having a single investment that lets you have a share in 100 odd, of those businesses. It's a great way to do it. I would suggest almost every Australian investor should have exposure to international assets. If you're going to do it no other way, an ASX listed international ETF of some description is a great option. And for me, the NASDAQ 100 is probably premier among them, not purely for diversification. There's better ones for diversification. I know you talk a lot about ETFs, Owen. You've done it before on the podcast and on this Rask Live platform. You're going to again, as you've already said. So yeah, ETFs really important.
Yeah, absolutely, Scott. I couldn't agree more. If anyone has any questions for Scott on ETFs in general, please send them in now. The NASDAQ ETF from BetaShares is definitely like the preeminent exposure for a lot of those technology companies and more broadly as well. And we can see, as we saw in the top 10 list just before, there's companies like Costco in there, which are just wonderful businesses, which I know you've been a big fan of for a long time. So
love Costco,
I mean, these types of businesses you simply cannot find here in Australia. I mean, you can find a Costco if you go to one of the main you go down and you get a hot dog and a drink for $2 or whatever it is. But I guess there was another question here, which is not really related to ETFs, but one from CP, which is a quick one, Scott. Do you have any like in mental models that you rely on when making decisions about investing? I know there are probably many that you think about, but just some that spring to mind when I say that.
There's heaps, mate. And one of the best things about investing is, unlike most pursuits in life, knowledge is cumulative. And so you actually become a better investor over time, in my opinion. Maybe eventually I'll hit senility and someone will tap me on the shoulder and say, Scott, that's enough. But you get better and better over time, right? And so the hardest thing about answering that question is so much of it becomes innate. You kind of just think through that process as part of what you do. I don't consciously say, I use that model for that thing. You kind of just build these models on top of each other and kind of go from there.
Yeah.
Man, simple ones. I'm trying not to be obvious, mate. Competitive advantages are number one for me with a bullet. So that kind of idea is probably the preeminent driver of my investing.
Yeah. I think that provides a natural segue, actually.
Yeah.
If I might cut you off.
Please.
If we talk about these businesses, right, the businesses that you've got here on the page,
Yep.
and one of them, if we shift gears, because it's probably the most similar in the way that people think about it relative to the ETF you just mentioned, which is Washington H. Salt Pattinson, ticker symbol SOL, which is kind of like people think of this like I'll let you explain what it is, but maybe through that, when you explain what it is, how do you think about like competitive advantage through the lens of Salt Pats?
Yeah, really great question. So I will say, by the way, Matt, I own every single one of those 5 companies. So let's get that up front. It's really important that I disclose that. And I don't want to forget to do it during the rest of the session. So let me just say once and for all, I own all 5 of those. Okay. Competitive advantage of Salt Pats. I'll describe the business first, just to avoid answering the question without describing it, and I'll go back to the business itself. Salt Pats is, for want of a better term, a listed investment company. And I say for want of a better term because it's an unusual listed investment company. Most LICs are investing. They're kind of shadow indexing to some degree, a bit of this, bit of that, bit more of this, bit less of that. Salt Pats is, as its core operation is investing money for shareholders. So it's a listed investment company by definition, if not literally described that way by everybody. But it's different because it owns all sorts of things. It owns businesses outright, owns whole businesses. It owns controlling majority stakes in a few businesses. It owns minority stakes in a whole lot of other businesses, and then a broad equity kind of portfolio, more like a traditional LIC. And you've got those component parts, which frankly makes it really difficult to think about. Make it a little more complex too. It has a cross shareholding in a sister company I also own shares in called Brickworks. So Brickworks owns shares in Salt Pats. Salt Pats owns shares in Brickworks. The whole thing's really complex. It was done to avoid a takeover back in the 70s and still remains in place today. So that's what it is. In terms of competitive advantage, mate, I'm glad you made the segue. Two areas of competitive advantage which overlap and are self-reinforcing. The first is the business itself. Robert Milner is the executive chairman. He is the 4th generation of the same family to run this business since it was listed on the stock market, the precursor of the ASX, way back at the beginning of last century, and the businesses go back to the late 19th century. So, it's 125 odd years listed or something ridiculous, 120 years listed. So it's super long-term management. They are super value conscious, not deep value investors, but they're conservative, long-term value-based investors. And if you're going to invest in any business that has a long-term track record and you're hoping it has more ahead of it, that sort of conservative long-term value approach, I think, is a really, really smart way to do it. Value. I'm not a value investor per se. I don't love those labels. I'm a bit, Buffett monger saying they're joined at the hip. I try and sit in the middle of that. But the approach they take of simply buying good businesses when they're cheap enough and they've got really great long-term prospects is important. So that's kind of the third competitive advantage is they have the ability to go anywhere with that cash. A little bit like Berkshire Hathaway. I don't want to make too strong a connection because they are different businesses, and I don't want to be accused of giving Soul Patts a halo it doesn't deserve. Although I had lunch with Rob Milner many years ago, a few years ago now, at the Berkshire AGM. He goes as well, which is saying something for a bloke who's a billionaire in his own right. When you turn up to listen to Warren Buffett, he hasn't let hubris go to his head. But it has the ability internally to deploy that cash in super tax-effective ways. So cash generated from one business can go back and be invested somewhere else, and therefore grow the value of the company over time. So they're the competitive advantages at head office level. Then they try and buy businesses that themselves have competitive advantages. And again, hence that kind of, the reinforcing layers of competitive advantage. Things about business like Brickworks itself, TPG Telecom, New Hope Coal, which is a bit polarizing, but it is whether you love or hate coal miners, it is the best coal miner in the country by a country mile in terms of quality and operational results. And then the other businesses they own shares in, they try and utilize those same opportunities. They've got a property portfolio. They've got an internal investment banking operation. They've got all sorts of stuff inside that business. And so they're looking for abilities to redeploy their own cash in those opportunities that are, as I said, self-reinforcing. They bought a fund manager not long ago, merged with Milton as well. So they're really kind of bulking up that business to I think, a really attractive degree. This is one for me, mate. There's only two companies I would happily put in the bottom drawer and look 20 years later. Berkshire is one. I own shares in that one. And Soul Patts for exactly the reason I just talked about. The internal diversification, the long-term culture of that company. Tom Milner, Robert's son, will probably be the next chairman. I would assume he's doing a great job running BKO Investment Management himself. So, good hands. Most of the family's money is tied up in Soul Patts shares. So again, I make the joke that if you think about, doesn't that focus the mind at Christmas parties? How many guys see the family say, what have you done this year? Robbie says, well, I tried to do what I could to, create some value. A really, really high quality, internally diversified business. One of, again, as I said, mate, one of the very few companies, because you don't know what's going to happen in business and in life. Yeah. But that conglomerate structure, they got a terrible name during the 70s and 80s because conglomerates were abused terribly. Wesfarmers is not one we'll talk about today, but those two are probably the exceptions that prove the rule, both in general, but also because of their survival. They have done a really good job with that conglomerate structure, and investors can feel really good about it.
Yeah, I couldn't agree. It's kind of like this anti-fragile approach to these companies, isn't it? Like, you have a business that can kind of take the hits and keep moving. I'm glad you said Tom Milner, because he's actually on the list here somewhere.
Oh, nice. There you go.
He'll be appearing on the show soon. There he is, right in the middle there. So Tom will actually be appearing on Rask Live in coming months, which I'm very, very excited for. There were a couple of questions that came through. One of them did come through from Joe, which was, are there any ETFs to avoid for beginner investors?
Yes, lots, heaps and heaps and heaps and heaps. Most of them, 95% of them. I'm not even kidding. I greatly dislike thematic ETFs, not necessarily, well, two reasons. Not because of the product, but because of the way they are marketed to and used by investors. So those are the two areas, right? Most investors will say, hey, I think electric cars are going to be big, therefore I should buy a lithium ETF. And they don't do the work between those 2 points. So it's too easy to, I think cybersecurity is going to be big. I'll buy that ETF. Or I think whatever, right? So what it does is it entices the investor, well, it does do it deliberately, actually. I'll get to that in a second. For the investor themselves, separate to the marketing of the ETF providers, it's a way of them saying, I have an idea of a theme. If I said, look, I think lithium is going to be big, what could I buy? I don't know, I'll look around, see what I can buy, and I'll look at those companies, work out which company to buy, and I might buy 2 or 3 of them, and that's how I might do it. Yeah. It's too easy to kind of go, lithium's a thing, therefore I'll buy the ETF, I'm really smart, the theme's real. And the simple example I'll use is air travel. In 1973, 50 years ago, if you'd have told me, hey, look, the growth in air travel will expand 1,000-fold over the next 50 years, I would have said, great, I'm selling the kids, I'm mortgaging the house, I'm going all on airline stocks, and I would have been spectacularly wrong. Why? Because I didn't think about the economics of the businesses, just the theme and the result, and said, hey, A plus B must equal C, I'm a genius, I'm going to be a millionaire. And so when you think about any ETF, what I call thematic ETFs, have you done the work on which companies are in there? What are their growth prospects? What are their financial fundamentals? What's their, valuation individually? And then you can add those up, and then you can buy the ETF if you want to. If you haven't done that middle bit of work, I really honestly think, mate, you have no business owning the ETF, and too many people do it. I'll give a swipe to most ETF providers too, not all of them. Won't name any because I'll save myself the legal trouble. Suffice it to say that these ETF providers create these products for exactly that purpose. You give it a catchy name, you give it a catchy ticker, and you say to people, hey, interested in area X? We've got an ETF for that. Now, they don't ever give the advice, so they get to skirt around the rules that you and I have to abide by, and they get to say, like lithium, buy my ETF. Like cybersecurity, buy my ETF. Like insert theme here, buy my ETF. They may or may not believe it's real, but let's be honest, they make money from just simply the size of the fund. Whether it goes well or badly, they really don't care. As long as you buy it and keep your money there for a while, they get to clip the ticket. So, yes, I would avoid. So my starting and finishing point for ETFs unless you've done that work in the middle I talked about, low cost, broad-based index ETFs. They're the only three categories. Tick all three boxes, and I would say knock yourself out. If you haven't ticked those three boxes, then you owe it to yourself, literally your financial self and your future self, to have at least done the work. Say which companies are in there, what are their growth prospects, what are their fundamentals, what's their valuation. Until you've done that, you have no business buying a thematic ETF, in my view.
Okay, so I'm going to quickly quiz you on something. This is the current and beautiful answer, by the way. I absolutely love that answer.
Thank you, mate.
But let's go back to Shakespeare.
The
fool is the one that can tell the king or the queen that they're not wearing any pants. Is that right? Something like that?
Close enough, mate. So the Motley Fool comes from, as you like it, the Shakespearean play, which is a fool. I see a fool in the forest, a motley fool. And the Motley Fool is the multicolored motley fool or court jester. And you're right. The court jester would stand in front of the court, and he would tell stories of truth. And if you went to the king and said, mate, you're making a big mistake, you say, well, you're off to the jail. I'll see you in 25 years. The jester could make it fun with a bit of song, a bit of jokes, and tell the truth. Now, I wasn't very subtle there. I was pretty direct. But yes, that's the theme. That's the idea behind the company.
Yeah, I like it, mate. I like it. So one question before we move on to the other three, which was from Dandef, I think is sharp, which is just asking a very simple question. You mentioned that Brickworks and Soul Patts have a cross shareholding. Mm-hmm. Is it worth having both? Like, could you just have one, for example?
Yes, you could. I own both. So the reason you own differently is they're different proportions. So I don't know the numbers, but I should. Brickworks now owns about 28% of Soul Patts. It used to own about 40%, and a lot of their earnings in the good years come from outside Soul Patts. So Soul Patts is 1/3 of that operating business. Similarly, Soul Patts gets some of its earnings from Brickworks, but most of the earnings come from outside that. So they own a chunk of each other, but in both cases, most of their earnings comes from outside. So you could absolutely own one, yes. And if you're going to own one, I'd go with Soul Patts personally. I own them both because the Brickworks business is bricks and tiles and property. And unless you have a particularly good view on that and you want the conglomerate, long-term, whatever, Soul Patts is much, I will say safer. I think that's fair. But certainly it's less likely to be hit by the vagaries of the economy. But at different times, Soul Patts have been cheaper than Brickworks or vice versa. And so when I bought Brickworks, it tends to have been when it was cheap. Mate, can I give a quick wrap to my own podcast, just very, very quickly? Not to wrap the podcast, but if you're interested in Brickworks, I did an interview with Lindsay Partridge, the CEO of Brickworks, on The Good Oil is the name of the podcast. Again, he's a plug, but I want you to hear Lindsay, not me, because a lot of people said, mate, that was the best interview I've ever heard. Lindsay was fantastic. It's never about me. It's always about the guest. But Lindsay was great. So if you want it, The Good Oil with Scott Phillips, it's called, because they had to put my name on it. And Lindsay Partridge, do that if you want to find out a bit more about Brickworks.
And correct me if I'm wrong, Scott, but on Motley Fool Money, people can write in questions as well?
Yeah, we do a mailbag episode once a week, which is
so. Yeah, so if we don't get to your questions tonight and you want to ask today and you want to ask Scott a few more questions, please just jump over there to the Motley Fool Money and the Good Oil, as Scott just said. Available in all good podcast players, I'm sure. Get it on Apple, Spotify, whatever you want. Yeah, no, for sure. I think it's wonderful when people come on and they tell us about what they actually do, because everyone here in the community is here to learn, Scott. So we all appreciate that. And a good reminder from Rob on the Selfwealth side of things that anything you hear today is limited to general financial information only. Always read the PDS, the product disclosure statement. There's also a new one called the TMD, or Target Market Determination. Gives you more information about who those products were designed for, and you can find out more online. Okay, Scott. So there was a couple other names here, which is interesting because you've kind of given us a medley of different names. We've got Beta Shares, which is the NASDAQ 100 ETF. We've got Washington Hayes sold Pattinson, or Sol, as it's sometimes called, which is more that listed investment company style thing. It's set up, it runs businesses, it buys businesses, it buys parts of businesses, etc. But then any of these three others that actually, can I direct you to corporate travel management?
Yep.
Because I know that you've been following this company for an extremely long period of time. And I'd love for you to introduce it. We've never, ever spoken about it, not only here on Rask Live, but also on Selfwealth Live before. Never spoken about this business. So can you tell us a bit about what it does? And maybe I'll bring up the website to help folks out.
Awesome, mate. Yes, thank you. So I own shares. This one I've said before, but I'll just reinforce that. Corporate travel management, funnily enough, does exactly what it says on the tin. It's a travel manager for corporates. And so this is a business that was founded, must be 25, 27 years ago, I think, by Jamie Ferris, the CEO, when he basically said, hey, corporate travel management, literally travel management for corporates is not being done very well. I'm going to jump in there and do it. He started the company with himself and 2 other staff members and built this thing effectively from the ground up. It's now a multinational, effectively a global travel manager. Basically allows companies to use they provide a system, a process, and some rules around travel for companies to give their employees. It provides reporting, benchmarking, billing, all that kind of stuff, as you would expect a corporate travel manager to do. So that's not particularly difficult, right? Every man his dog has one. Amex has one. Flight Centre has one. Travel managers aren't very unusual. What corporate travel management has managed to do is to attract and retain a remarkably large number of customers, and then grow that business over time, both organically and by acquisition, to the size it is today. It was, and here's what I really like about this business, mate. We had recommended at Share Advisor 3 travel managers: Flight Centre, Webjet, and Corporate Travel. Hello World's the 4th on the ASX. Of those 4, I'm pretty sure it's true of Hello World. It's definitely true of Webjet and Flight Centre. Corporate Travel was the only one that didn't raise capital during COVID. Now, if you think about the impact of that pandemic on everybody, but specifically travel managers and airlines, if you're not flying, you're not billing, right? They had to lay off 2,200 out of 3,000 staff at the beginning of COVID, and I did the other travel managers, which just sucked for everybody. But they managed to run their business in such a way that while Flight Centre and Webjet almost doubled their share count during COVID, Corporate Travel didn't issue a single additional share for the purposes of working capital during COVID. They have before and after for acquisitions, but for that particular purpose, there was no need to, because they'd run the business conservatively, and yet still have grown phenomenally over the years. This was a $2-ish share price, maybe $2.20 or something, back in 2012 when I recommended it to our members. 11 years later, it's still a buy on the Motley Full Share Advisor scorecard. It's always been a buy, except for that period during COVID, which was a hold for obvious reasons. We weren't sure what the future would bring. It's done really, really, really well. They focus on attracting and retaining great customers and great staff. They run the business really in the interest of shareholders. It's a bit of inside baseball, mate, a bit detailed for a lunchtime chat. But when they raised a large amount of capital a few years ago, they used a renounceable rights offer, which almost nobody does. It's the most shareholder-friendly way of raising capital. It's done pro rata, so per share. No one gets an institutional raising or a free kick. It's renounceable, so if you didn't want to take up the rights, you weren't forced to or lose the value of those rights. Not me. I could count in one hand the number of large companies that's done it that way in the last 10 years that I've been doing this. And Corporate Travel is one of them. So it's a really good business. They're growing fantastically. Founder CEOs, which I love. Sol Patts hasn't got a founder CEO because the founder's long gone, but family kind of CEO, close enough to founder CEO kind of culture. So Jamie Ferris, really good guy, doing a great job running that business, growing it nicely. They've grown by acquisition and organically for the last 20-something years. They're now a global player, still relatively small as market share, so there's still plenty of opportunity left, which is why I still like it. They can keep doing what they're doing and just continue to attract more customers. Their retention rate's like something like 97%, which, for a service business, when you can literally just walk across the road for a cheaper price or a better service or some sexier kind of tech, when you keep that many people with reasonably low barriers to exit for customers, it says they're doing a lot of things right.
Yeah, and to be able to retain and profit from those customers. I'm conscious of time, but one of the things I did want... No, not at all. I love it. I could be here all day. But
me too.
But one of the things that I remember was when Corporate Travel was the victim, I would say, I'll call it a victim, of a short selling allegation that came out, basically said a whole bunch of different things. And I remember you having to stand up in front of Share Advisor members, but also just in the community at large, and take a lot of criticism because people, it sounded really smart. It sounded really smart what this short seller was saying.
Yep.
And if we fast forward now, however many years later it is, and so people look at the long-term performance of something like corporate travel and they say, well, that was pretty easy in hindsight, corporate travel, etc.
Right.
But along that path, there's been COVID, there's been short selling, there's been all of these different weird and not so wonderful things that you've had to hold through. So kudos to you. So the last two companies that we've got on our list here, mate, one of them or both of them I'd imagine people are familiar with. They probably know Kogan because they can get cheap TVs, and they probably know Adore Beauty because if you buy a beauty product, you get a small Tim Tam along with the order. But maybe if we go with Kogan, I know you followed the business for a long time. I believe you've interviewed Ruslan Kogan. I don't know if that was just for members or if it was public, but I know you've interviewed the founder. So maybe if we start with Kogan, the e-commerce business.
Yeah, he was also on the good oil, so apologies for the second
plug,
but yeah, you can look that up as well. So look, I'll bracket the e-commerce players a little bit, mate, talk about them broadly because it'll save us a bit of time, but we can talk about Adore separately anyway. I reckon most people are missing the big story here in retail. We've had so much volatility over the last 3 years with the ups and downs of COVID. Everyone rushed to online because you couldn't get out of the house. Then everyone went back to the shops, and so these online retailers' sales fell away, massively because people went, well, I liked it, but I'd rather go back to the shops, please. So that's being hidden. If you look at the longer term story, the uptake of e-commerce is still one of the great disruptions of our time. And if you look at the proportion of sales, for example, in the UK and the US that are online compared to Australia, not only have they got, I think they've got more to go too, by the way. I think we are miles behind. I've said before, I reckon at some sort of terminal rate, eventually, no predictions on time frame. I reckon eventually we'll do something like 2/3 of our retail sales online. Now, at the moment, it's probably low double-digit percentages. Now, I might be wrong, but if I'm wrong, if I'm half wrong, there's still a threefold increase in e-commerce uptake, right? I don't think I am. I think realistically, people said, well, you'll never buy movies online. Okay, you'll do that. Well, you won't buy music. Well, okay, you do that. Well, you won't buy books. Well, you'll do that. Okay. Now people are buying couches and beds online. The things that were supposed to be well, of course you wouldn't buy a bed online. I mean, you'd want to check it first, wouldn't you? Now, not everyone's going to.
Scott, I didn't. I just went straight to the reviews.
There you go.
I just went straight and bought the bed online.
And that's it, right? So now some people still buy physically. People are watching this now saying, I'll never do that. You probably won't. My wife and mother, right? Two examples. My wife loved going to the shops, checking stuff out. COVID came. She started shopping online. Now that's I'm going to say 85% of her discretionary shopping is online. My mother, who was, a sprightly young pensioner, but she's still a pensioner. We were talking the other day. I said, Mum, you really should get Prime. She said, oh, I don't think so. It's expensive. How much do you buy on Amazon? She said, oh, yeah, most things. So, yeah, and my point is that, and that's just anecdotal, right? But over time, we will buy more and more and more online. Now, by the way, be very careful of physical retailers and physical retail REITs, which is a whole different conversation we'll have another day. But just be very careful because the trend is still ongoing. Yes, there's bumps in the road, like the stock market. Throw up the Vanguard index chart if you get a chance. The bumps there have been all over the place, but we know the phenomenal value that's been created. And my strong conviction with both Kogan and Adore and others, by the way, I think e-commerce will be much, much, much larger in future still than it is today. And that, I think, is what's driving my trend-wise. I'm not a trend follower. I'm not a top-down investor. But with that as the tailwind, then you go to Kogan. Kogan has continued to really drag in lots and lots and lots of customers. Oh, there you go. I love that chart. Look at the drops on that chart, right? Look at the times when it fell, and yet look at the total result overall. And that's the story of investing, by the way, which is the key investing chart. That one picture is literally the 1,000 words on investing. But back to Kogan, it's had a similar, ups and downs. It's continued to add customers. Its Kogan First program continues to add customers again through down year on year because this time, 18 months ago, we were all still buying stuff online. It'll continue to grow in my view, and if it can, then I think it can get much, much bigger a revenue line. And if it does that at a reasonable margin, then I think there's a very, very attractive future for Kogan. Everyone's hating on it right now, not as much as 12 months ago, speaking of holding through pain. But the long term, I think, for Kogan is bright. Now, it may not be. There are some of these online retailers won't be the winners. They will be the either mediocre or losers, and that may well be the case for either or both of these two companies. But overall, I think retail is going to continue to grow online. These guys are well poised to gain from it. You don't have to be at Amazon to do really, really well. Same's true in the US as here. I think Kogan will do really nicely. Ruslan Kogan, founder CEO again, large fortune in those shares. wanting to build the right business for the long term. They made some mistakes. They had too much inventory. They got absolutely smashed with that. They made a bet and got it wrong. You know, who could have known? Could they have done things differently? Maybe, but hindsight's always 20/20, as you said before. So I think it's a really well-run business. It's using data first. The verticals are a really great way to monetize its customer base. I think it's got a bright future ahead of it.
I like it. Very similar to the businesses that I know pretty well, which are these online businesses that can just extend, like they figured out customer acquisition and they can extend the lifetime value of the business. In this case, they offer more verticals. But one business that doesn't offer too many verticals, Scott, is Adore Beauty, which we can see here as the logo. So Adore Beauty trades under the ticker symbol ABY.
Correct.
But Adore Beauty, Kate Morris is the founder of the business. Her and her partner ran it for a long time. And you can see here, most people will know the business, particularly maybe if it's just through COVID or whatever. But she's got a wonderful story to tell about the back catalogue of the business and how they went through trials and tribulations to get to an IPO, and then since then. Can you talk to us a bit about this business? Like, how does this fit then relative to, say, Kogan, which offers kind of everything?
So Adore is, to my mind, mate, it's a much earlier stage business than Kogan, despite the fact it's been around for a long time. But in terms of uptake and growth of this category, I think there's a long way left to go. The opportunity for Adore is being able to, so Kogan has cut price, right? That's where it lives. It wants to earn your loyalty through giving you the best prices. It says that itself. It's trying to provide value for customers. Now, no retailer is going to say they don't provide value, but Adore's two key components here are brand loyalty and customer experience. You mentioned the Tim Tam before. The fact that is so well known for everybody is such a masterstroke, right? If you're trying to build an online brand and you want to buy a beauty product, where are you going to go? You're probably going to go to Adore Beauty. Now, you might start on Google. You might find something else. You might find the price slightly cheaper. They're going to have to compete on price at some point. They have got a decent home brand range coming to market where they don't have to compete, which is good for them. But it comes down to the community and the brand. Now, the community is through a lot of social media, through podcasts. Speaking of podcasts, a lot of social media stuff. The way they deal with their customers at Adore, they don't push product. When you speak to their customer service, they try and answer your questions, buy whatever you want from whatever you want. There's no link at all. There wasn't, at least last time I checked. There's no incentive for their customer service people to sell anything. It was just, hey, let's be a brand people know, trust, love, and want to return to. And if you get that right, that's how you overcome the price fighting and the price comparison only. Now, I said they're going to have to compete on price, but I think the brand loyalty they're building and their repeat customer numbers are really strong. They didn't get as many new customers in the door last 12 months. Surprise, surprise, because people went back to the shops. But over time, when that normalizes, again, a bit like back to corporate travel, if you can get more customers and keep most of them, you start to compound your business, and it really does climb and climb and climb. It's really cheap right now, mate. And again, these Kogan and Adore are clearly the riskiest of the five we've talked about. Either or both could fail, frankly, if things go really badly, or just be disappointing share price wise. Adore's share price is down so far recently. I think it's a really good opportunity. Again, no guarantees, no promises, as we heard before. This is not personal advice, but I think it's very well poised to continue to grow and do well. Once things right size, what will happen? So here's my guess, mate. In 12 months' time, we'll look back and the headlines will be e-commerce is back. And I will say at that point, it never really went anywhere. You just missed in the shape of the curve. People kind of thought somehow that it had gone forever, and that's what investors and the media do, right? We lose patience. The story of the day moves on. When they get year-on-year growth in some of these businesses from a new post-COVID base, all of a sudden it'll be like, oh, these things are real. This is actually growing. This could be something, and I think that's what we'll see. Even for other businesses, by the way, Premier Investments, another company I love. It's mainly a physical retailer, but 25% of its sales are online. These are going to grow and grow and grow, and winning the online war is going to set you up for decades of success. And I think we're seeing those winners come to the fore over the next 12 or 24 months. So again, I'm not timing the market. I'm just saying these are going to be bigger and better businesses. But by the time the headlines are in, and I think that'll probably be this time next year, maybe June, July next year, if I'm right, I could be wrong. By then, if that happens, the market will start to again wake up to these things. So they're not exactly under the radar players, but I think they are unloved, underappreciated companies right now.
I really like that variant perception that you have, mate, and the long-term focus. Scott is very, very well intentioned with his long-term investing. I'm just speaking on behalf of you here, but
Thank you, mate.
A lot of people hear like things might happen, they might not happen, and people think that it's lacking in conviction. And I think that's a mistake that a lot of people make, because we cannot predict the future. It's not a lacking in conviction. It's actually just being humble, because the longer you invest, the more humble you become. That's like when Warren Buffett gets asked at the AGMs for stock ideas, he never says anything, because he's like, I'm not here to give you stock tips, because that's not necessarily what this event is about. It's about educating you for long-term investing. Now, you can obviously do that with members because they subscribe and they pay for that. But before I get to my final question, I've just got a few things. So one is people can go to the Good Oil podcast, which Rob for the Selfwealth community has popped that in the chat there. The Good Oil podcast with Scott Phillips. Go and check that out. There's also Motley Fool Money. If I'm not mistaken, that's there's plenty of Motley Fool podcasts from the US, but Motley Fool Money is the Australian one. And you can head to fool.com.au. You oversee Share Advisor in particular, and people can subscribe and check that out, which is fantastic. Have I missed anything? Oh, Twitter, of course.
I'm all over the place. TMF Scott P on Twitter. I've got a Facebook account as well. I'm Eddie everywhere, mate. So people call me nasty names. There's names for people like me apparently, but you're right. Look, the Motley Fool's a paid business, and we love people paying, and we're happy if people do. We make a bit of money. That's great. But I've also never been restricted from doing things like this or being on Twitter or TV or whatever. I've always joked if I was born in the 1800s, I would have been a stump preacher. You and I share a passion for educating investors, for sharing that Vanguard chart again is, if I wasn't working for the Motley Fool, I'd be doing this in some other format, right? Because once you can really genuinely show people the power of long-term investing, and you do a spectacular job of this, you are changing lives, mate. You're changing countless lives, and I think that is a calling worth following. We're not doing, it's not brain surgery, and we're not putting rockets on the moon, but it's a pretty important one, I think.
Thanks, mate. Right back at you, of course. But the final question that I have for you, because I'm just conscious of time, is. This is a question that I did send to you in advance because I wanted to pick your brain on this one. And I said to you, interest rates are up. People seem worried. Should investors be optimistic about long-term investing? If so, how can we try to stay optimistic?
Love it, mate. So the first question is rhetorical. Absolutely, yes. There has never been a time in modern history when it's been a bad time to invest, right? In fact, the only thing that's better than investing now is investing 5, 10, 15, 20 or 40 years ago. Which is not, and you mentioned long term. I appreciate you saying that, mate. In life in general, the older you get, the more you learn, the more you realize you don't know, and arrogance is poison, absolute poison in investing. But I don't know anything that's more likely, nothing certain, I'm allowed to say that, neither are you, nothing more likely than the stock market going up over a long period of time, because it is the numerical result of human ingenuity, passion, inventiveness, desire to improve things. We just are as a species wired that way. We will continue to do that for years and years and years and years to come. Any point people thought history was over, technology had peaked, there was nothing more to invent, nothing more to imagine, nothing more to do. We just talked about AI already. They were all mistakes. That Vanguard chart, and frankly any chart, the Australian stock market, going back to a Credit Suisse report from I think it's 1900, it might be 1906, I can't remember now. The Australian stock market gained a real return of about 6% a year. At inflation, you're back to about 9%, which is the long run average nominally of the stock market. If you believe capitalism's best days are behind us, don't invest. But I have absolutely no doubt that our best days are in front of us because of the reasons I just talked about then. To people inventing new solutions to new problems, new solutions to old problems, new wants, new needs. Again, it's literally the microcosm of society's progress. So I'm absolutely evangelistic about it. I don't take that back. How can people stay optimistic in these current circumstances? The best thing you can do is just, stare at the Vanguard chart till your eyes bleed. The reality is, and it's hard, right? It's so much better being me than you, mate, because I'm old and I've been through this before. Some of viewers may have been around for a while, others won't have been. When you've seen this happen before, firstly, learn from history, right? Life's too short to make all your own mistakes. Learn from others' mistakes. So take history. Take the Great Depression, World War I, World War II, Korea, Vietnam, the Gulf, the oil price spike during the late 70s, and high inflation in the 80s, by the way. If you don't think we have been here before with high inflation, it was only 40 years ago. It wasn't that long ago. We've been through Gulf wars, we've been through terrorist attacks, we've been through, you name it, we've been through it, right? This is not abnormal. This is normal. What was abnormal was 40 years of no inflation. So when you look back at that Vanguard chart, firstly see the growth, and people say, yeah, but look, it's already so high. Look at that. And that's the worst thing about that chart is people look at the top right and go, look how much it's grown. Clearly, obviously, we're past that point. There can be no more left. Surely we must be done by now. And yet that could have been said in 1998. It could have been said in 1983. It could have been said in 1972, 1961. Choose your decade, choose your year. Now, there have been some bad periods where shares have gone nowhere. Microsoft went nowhere from the dot-com boom for the next 15 years. So I'm not promising you things will go straight up and straight to the right. But if capitalism hasn't peaked, and you look back and say, we've been through this before, I usually say, mate, the stock market has risen in spite of, not in the absence of, bad events and reasons to worry, right? That is the reality of investing. So this is, you know, if you're deeply pessimistic about humanity, then I can't help you. If you're optimistic about humanity, you're optimistic about the potential for our future, then investing is the way to harness that and benefit from it. So how do you stay positive in this sort of environment? Look at the history, look at what we've overcome, look at where we've been. Recently, the GFC, the COVID crash itself, literally only 3 years ago. The Asian financial crisis in 97, no one talks about anymore because the two crises since were worse, which is fair and appropriate, but we've come back from those things. And so that's my take. It's also why, if you look at some of the companies that we've talked about today, Kogan and Adore have been at much higher prices in the past, and fair enough. Are they really done? Has their growth really finished? Are they really going to show nothing from this? I don't think so. So I'm supremely optimistic about the future. I can't make promises. I wouldn't make promises, but I don't know of a better way to harness human ingenuity and profit from it rather than invest. But I will finish, mate. This is a long monologue. But you've got to be long term. Don't invest without conviction. Don't invest just for the next week, the next month, the next year. I don't know where the share price is going to be in a year's time. It could be down 25% for all I care. And if they are, I'll be investing. If they're up 25%, I'll be investing. So dollar cost average, do it regularly. If you don't want to pick stocks, buy an ETF. The market has always gone up over time, despite the occasional pullbacks. Keep investing regardless. Don't try and time the market. Don't try and be too clever. Just put your money to work every day, every week, every month. When the share prices are down, you get to buy more shares. When they're up, okay, you buy a few less, but you've already got some money invested. That goes up as well. I don't know, mate. I'm absolute dyed in the wool. By the way, very, very, very quickly, I'm a shares guy because I believe in shares. I'm not saying I believe in shares because I'm a shares guy, right? I'd happily buy property if that was better. I'd happily buy, I don't know, marbles if they were going to give me a better return too. So I'm not saying buy shares just because I'm a shares guy, because the business I work for happens to be in shares. I took a decent pay cut when I joined the Motley Fool a long time ago because I wanted to be part of this because I believed in it. I wasn't a gun for hire who said, I'll spruik whatever you want. This I'd learned from some of the Motley Fool guys in the US when I was a customer. I went, hey, if I can share some of this stuff, then I want to be part of that. So be optimistic, be positive. The future will be better than the past. Companies will make more money in the future than in the past. Share prices will go higher, in my view, than they have in the past.
I think all of us, myself included, are going to have to listen to that last 5 minutes again, Scott, just so we can capture all of the nuggets of wisdom. I didn't expect you to end that way, but I sincerely do appreciate that. And for anyone that is watching and listening to this on replay, even go and check out all of Scott's material. I've learned so much from Scott over the years, whether it's just been through a tweet or a message or an email or whatever the case may be, seeing behind the curtain at the Motley Fool too. So go and check it out. Scott, mate, I'll say good day to you. I'll let you go have your lunch and enjoy the rest of that. Looks like a Coke you've got there. I'm a bit envious of that. But
indeed.
Yeah, thanks so much, mate. And bye for now, and we'll see you next time.
Mate, thank you for inviting me. I really have enjoyed the last hour. Thanks for everyone who's watched and taken part too. Really appreciate the interactions.
Cheers. Thanks, Scott. That was Scott Phillips, Chief Investment Officer of the Motley Fool. What an absolute delight. I could just sit here and learn like the rest of us. So I'm going to really say thank you once again to Scott and for making time out of his busy day as well. So I'm just going to end with a couple of things for today. Thanks to Rob from Selfwealth for jumping in the chat as well, just quickly. In the next few weeks, we will be back with more guests, more topics that you will love. So don't forget to dial in. You can also send any of your comments in now or just in the comments section of any of the places that you get your video and just say what companies or what ETFs would you want us to cover, what funds, which guests do you want us to get on the show, because that's a big part of what we do. And finally, don't forget to come along to a Rask Roadshow We've got one final event in Sydney next week. It's on Tuesday night. If you're in or around Sydney and you can make the trip up, that'd be wonderful. And the following day, we've got a value investor workshop in Sydney. That is a paid thing, but you can come along if you want to do an intensive day with me at the Magellan head office in Sydney. So they've been kind enough to put up their office for us, for me and a small group of people to learn the art of value investing if you're interested. So go and check that out. Next week, we'll be covering a few different things, but I'll finish with a quote. And this is really relevant because I thought the way Scott ended, and this would be perfect for it, is avoiding loss is the most important prerequisite to investment success. Scott once told me, just in a message to me, I think it was via Slack one day, he said, I gave him an example of something that I did that was a mistake. And he said, I'm convinced, and I'm paraphrasing him here, I'm convinced that good investing has a lot to do with the mistakes you avoid than the winners you kind of hit home. So I think that's a really good lesson. And Seth Klarman here wrote a book called Margin of Safety, which is about, I think it's about $3,000 if you try and get a hard copy of the book. But I haven't got a copy myself, so I can't tell you if it's any good, but or worth the money. But it's got a price tag, so maybe it's worth it. But thank you, everyone, once again for tuning in this week. Next week, we will be back to our regular programming at 6 p.m. Australian Eastern Time. I hope you can make it then. Don't forget to hit subscribe, whether you're on Rask, Selfwealth, or the Australian Investors Association. Check that out. And I'll be back next week. Don't forget to put your suggestions in the comments for guests and for topics for us to cover in the future. We'll be covering lots more next week and the week beyond. So bye for now. Thanks for the Rob and everyone that contributed. I really do appreciate it. And I'll see you on the road.